Every single day, millions of tons of trash are created. Most people never think about where it goes. But behind this dirty, invisible industry, there is a business that has quietly created enormous shareholder wealth for decades. A business with recurring revenue, high barriers to entry, strong pricing power, and surprisingly consistent cash flow. This is not a glamorous AI company, not a hypergrowth tech stock. It's a trash business. And yet, waste management has become one of the greatest long-term compounders in the market. So the question is, how did a simple trash company become a long-term compounding machine for investors? Even the greatest business in the world can become a bad investment if you pay too much for it. That is why valuation matters. A company like Waste Management may have strong recurring revenue, stable cash flow, pricing power, and a durable competitive moat. But investors also need to ask, how much future growth is already priced into the stock? Because when expectations become too optimistic, future returns can become limited, even if the business itself continues to perform well. This is one of the most important lessons in investing. A great business does not always mean a great buying opportunity. Valuation helps investors separate business quality from investment return potential. And for long-term investors, that difference matters enormously. What is a stock really worth? That question sits at the center of investing. Fair value is an estimate of what a business is worth, based on its earnings, cash flow, growth potential, and long-term business quality. The market price, however, can move far above or far below that intrinsic value. Sometimes investors become too optimistic. Sometimes they become too fearful. And that creates the gap between price and value. For a company like Waste Management, fair value is not just about short-term earnings. Investors also consider recurring revenue, pricing power, landfill assets, free cash flow generation, and long-term compounding potential. Because ultimately, the goal of valuation is not to predict daily stock movements. It is to understand whether investors are paying too little, fairly, or too much for the future cash-generating power of the business. So how should investors read this valuation slide? This model uses a PE multiple approach to estimate the potential fair value range for waste management stock. Instead of relying on a single number, the valuation is divided into three scenarios: conservative, historical, and optimistic. The conservative case applies a lower PE multiple, reflecting slower growth expectations, or more cautious market sentiment. In this scenario, the estimated valuation is around $195 per share. The historical scenario uses Waste Management's more normalized valuation range based on long-term market behavior. This produces a fair value estimate of approximately $209 per share. Meanwhile, the optimistic scenario assumes the market continues assigning a premium valuation due to strong business quality, recurring cash flow, and defensive characteristics. Under that assumption, the valuation could reach around $260 per share. The key idea here is not predicting exact short-term price movements. Instead, this framework helps investors understand what the market may already be pricing in, and whether the stock appears undervalued, fairly valued, or potentially overvalued relative to its long-term fundamentals. To understand why waste management became such a powerful long-term compounder, we first need to understand the business itself. At first glance, the company simply collects trash. But underneath that simple business model is a massive infrastructure network. Waste management operates collection routes, transfer stations, recycling facilities, and one of the largest landfill networks in North America. And that scale matters enormously. Because waste collection is not just about picking up garbage. It's about controlling the entire system. From collection, to transportation, to final disposal. This creates an integrated business model that is extremely difficult to replicate. But the real competitive advantage lies in the landfills. Building new landfills today is incredibly difficult. Environmental regulations are strict. Permits can take years. And local communities often oppose new landfill projects. As a result, existing landfill operators own highly valuable assets with limited competition. That gives companies like Waste Management pricing power, operational efficiency, and long-term recurring demand. Because no matter what happens in the economy, cities still produce trash, businesses still generate waste, and households still need collection services. In many ways, waste management operates more like critical infrastructure than a traditional cyclical business. One of the most overlooked strengths of the waste industry is its stability. Because unlike many businesses, trash generation does not stop during economic downturns. People still consume products. Homes still produce waste. Restaurants still throw away food. And cities still require sanitation services. That makes waste collection an essential service, rather than a discretionary expense. During recessions, many industries experience falling demand, shrinking revenue, and collapsing margins. But the waste industry tends to remain remarkably resilient. In fact, the business model is built around recurring demand. Most customers rely on scheduled collection services, weekly, monthly, and long-term contractual agreements. That creates highly predictable revenue streams and stable cash flow generation. Another important advantage is pricing power. Because waste disposal infrastructure is limited, especially landfills, large operators can gradually increase prices over time. And since waste collection represents a necessary operational cost for customers, demand tends to remain relatively sticky. This combination of essential services, recurring revenue, infrastructure scarcity, and pricing power creates a business model that can remain durable across economic cycles. That is why many long-term investors view waste management not as a simple garbage company, but as a defensive cash flow compounder. The true competitive moat of waste management is not the garbage truck. It's the infrastructure behind the business, especially the landfills. Because in the waste industry, landfills are incredibly difficult to replace. Building a new landfill today can take years of approvals, massive capital investment, and intense regulatory review. On top of that, local communities often oppose new landfill developments. As a result, existing landfill operators control scarce and highly valuable assets. And scarcity creates pricing power. The fewer disposal alternatives available in a region, the stronger the economics become for companies that already own the infrastructure. But there is another hidden advantage in this business. Route density. Waste collection becomes far more profitable when a company can serve many customers within concentrated geographic areas. Why? Because higher route density means shorter driving distances, lower fuel costs, better labor efficiency, and higher operating margins. In simple terms, the more customers waste management serves within the same route, the more efficient the business becomes. This creates a scale advantage that smaller competitors often struggle to match. And over time, large operators can continue expanding efficiency through acquisitions and network optimization. That combination of scarce landfill assets, infrastructure scale, route density, and pricing power creates a powerful economic moat. A moat that becomes increasingly difficult to replicate over time. And that is one of the main reasons why waste management has been able to compound shareholder value for decades. In the first quarter of 2026, Waste Management once again demonstrated why many investors view the company as a long-term cash flow compounder. Revenue increased to approximately $6.2 billion. Supported by pricing strength, operational efficiency, and continued growth across the business. Adjusted earnings per share came in at $1.81, while adjusted operating EBITDA reached nearly $1.85 billion. But perhaps the most important number for long-term investors was free cash flow. Free cash flow nearly doubled year-over-year to around $920 million in just one quarter. That matters because free cash flow represents the real cash a business can generate after supporting operations and capital investments. And for a company like Waste Management, strong cash flow creates flexibility. Flexibility to pay dividends, repurchase shares, reduce leverage, and continue investing in long-term growth projects. Management also highlighted continued momentum in recycling automation, renewable natural gas infrastructure, and operational optimization initiatives. At the same time, operating margins continued to improve despite weather-related headwinds during the quarter. This is an important point, because it shows the strength of the business model. Even in a slower economic environment, Waste Management continues generating resilient earnings, stable margins, and powerful cash flow. And that consistency is exactly what many long-term investors look for in a compounding business. For decades, many investors viewed the waste industry as a slow-moving old economy business. But today, the industry is evolving into something much larger. Because modern waste management is no longer just about collecting trash. It is increasingly becoming an environmental infrastructure business. And Waste Management is investing heavily in that transition. One of the biggest opportunities comes from renewable natural gas. Landfills naturally produce methane gas as waste decomposes over time. Historically, much of that gas was simply released into the atmosphere. But today, Waste management can capture that methane, process it, and convert it into renewable natural gas. That creates an entirely new monetization opportunity from assets the company already owns. At the same time, the company continues investing in advanced recycling facilities, automation technology, and sustainability infrastructure. These investments may improve operational efficiency, long-term margins, and environmental performance. And as governments and corporations push toward stricter sustainability goals, demand for modern waste solutions may continue increasing. That is an important shift investors should understand. Because the future of the waste industry is not simply about garbage collection anymore. It is increasingly connected to recycling, renewable energy, resource recovery, and environmental services. In other words, what once looked like a boring trash business may gradually evolve into a critical part of the modern sustainability economy. Now, let's take a look at a small portion of waste management's financial ratios for FY 2025 and 2024. Now, let's take a closer look at several key financial ratios from waste management for fiscal year 2025 and 2024. Let's start with gross margin. In FY 2025, Waste Management reported a gross margin of 40.44%, compared with 39.34% in FY 2024. Gross margin measures how much profit the company keeps after covering the direct cost of providing its services. In simple terms, for every $100 of revenue generated in 2025, Waste Management kept about $40 before operating expenses and other costs. The improvement from 39% to over 40% suggests stronger operational efficiency, better pricing, and improved cost management. Next is return on invested capital, or ROIC. In FY 2025, ROIC came in at 10.54%, slightly lower than 11.65% in FY 2024. ROIC measures how efficiently a company generates profit from the capital invested into the business. This is one of the most important metrics for long-term investors. A consistently high ROIC often indicates strong competitive advantages, efficient management, and quality capital allocation. Although ROIC declined slightly year over year, the company still maintained double-digit returns, which remains solid for a large infrastructure-heavy business like waste management. Now let's look at free cash flow margin. In FY 2025, FCF margin increased significantly to 13.21%, up from 9.92% in FY 2024. Free cash flow margin measures how much actual cash the company generates from its revenue after capital expenditures. In practical terms, for every $100 in revenue, Waste Management generated more than $13 in free cash flow during 2025. That improvement is important, because free cash flow is what supports dividends, share buybacks, debt reduction, and future investments. Finally, we come to interest coverage. In FY 2025, interest coverage was around 4 times, compared with approximately 5 times in FY 2024. Interest coverage measures How easily a company can pay its interest expenses. Using operating income. The slight decline versus the previous year likely reflects higher debt levels and increased interest costs. However, for a stable cash-generating business like waste management, coverage at this level is still generally considered healthy. Overall, these financial ratios show a business that continues to demonstrate strong profitability, resilient cash flow, and durable operational strength, even while navigating higher financing costs and ongoing investments for future growth. So why do long-term investors continue to love businesses like waste management? Because behind this seemingly simple business are several powerful long-term catalysts. First, the company operates in an essential industry. No matter how strong or weak the economy becomes, waste collection remains necessary. That creates highly recurring demand and stable cash flow generation over time. Second, waste management benefits from strong pricing power. Because landfill infrastructure is limited and difficult to replicate, large operators can gradually raise prices over time. And in many cases, customers have very few alternatives. Third, the company continues benefiting from scale advantages. Higher route density, integrated infrastructure, and operational efficiency can support margin expansion over the long run. Another important catalyst is free cash flow growth. As the business continues generating strong cash flow, management gains more flexibility to increase dividends, repurchase shares, reduce debt, and reinvest into future growth opportunities. At the same time, the industry itself is evolving. Waste management is expanding into recycling automation, renewable natural gas, and sustainability infrastructure. These businesses could create additional long-term revenue streams beyond traditional waste collection. And finally, there is the power of consistency. Many investors underestimate how valuable a stable compounding business can become over decades. Because long-term wealth creation is often driven not by excitement, but by businesses capable of generating predictable earnings, resilient cash flow, and disciplined capital allocation year after year. And that is exactly why companies like Waste Management continue attracting long-term investors. Of course, no business is completely risk-free. And despite its strong long-term qualities, waste management still faces several important risks investors should understand. One of the biggest risks is rising operating costs. The waste industry depends heavily on fuel, labor, transportation, and maintenance expenses. If fuel prices rise sharply, or labor costs continue increasing, profit margins could face pressure. Another important risk is regulation. Because waste management is a highly regulated industry, companies must comply with strict environmental standards. Changes in environmental laws, landfill regulations, or emissions requirements could increase operating costs over time. There is also the risk of environmental liabilities. Operating landfills and waste infrastructure comes with long-term environmental responsibilities, unexpected remediation costs, or legal issues could impact future profitability. Investors should also monitor debt levels. Large infrastructure businesses often require significant capital investment, and acquisitions can increase leverage. Higher interest rates may raise financing costs and reduce financial flexibility. Another challenge is slower industrial or commercial activity. Although residential waste tends to remain stable, industrial waste volumes can weaken during economic slowdowns. And finally, there is valuation risk. Because waste management is widely viewed as a high-quality defensive business, the stock often trades at premium valuation multiples. That means future investment returns may become more dependent on continued earnings growth rather than multiple expansion. In other words, even great businesses can still become disappointing investments if investors pay too high a price. So after analyzing the business, the financials, the competitive moat, and the long-term opportunities, what can investors learn from waste management? First, great businesses are not always glamorous. Sometimes, the market's strongest long-term compounders operate in industries most people completely ignore. Waste management is a perfect example. Behind this simple trash business is a powerful economic model built on recurring demand, infrastructure assets, pricing power, route density, and strong free cash flow generation. Second, consistency matters. The company may not deliver explosive hypergrowth, but its ability to generate stable earnings and cash flow across economic cycles is exactly what many long-term investors value. Third, the moat appears extremely difficult to replicate. Landfills, regulatory barriers, and network scale create advantages that smaller competitors struggle to match. And over time, those advantages can strengthen even further. At the same time, investors should remain disciplined, because even high-quality businesses can become risky investments when valuation becomes excessively expensive. That is why understanding both business quality and valuation is essential for long-term investing success. Ultimately, waste management demonstrates an important investing lesson. Long-term wealth creation does not always come from the most exciting businesses. Sometimes, it comes from durable companies that quietly compound cash flow year after year, for decades. And ironically, one of the dirtiest businesses in the world has become one of the cleanest long-term compounders for investors. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.